Hi friends, welcome back to Murthy Finance Academy. Today, the third company which we are going to discuss in the gold jewelry space is Senco Gold Limited. If you didn't watch the previous two videos which I made on PN Gadgil Jewelers and Sky Gold, please do watch them and come back to this video. So before proceeding again, a quick disclaimer. Whatever the company we are going to discuss is purely for educational purpose. Please do not consider it as a buy or sell recommendation. Please consult it always your financial advisor. I am not a SEBI registered analyst. Now let us start. So Senco Gold. This is a resilience amidst gold bull run company kind of a thing. Senco Gold isn't just selling jewelry. They are selling an 85-year-old insurance policy and trust. In an Indian market still plagued by unorganized players and purity concerns, Senco's trust moat is its most valuable asset. Since shifting from a family partnership to a corporate powerhouse in 1994, the fourth generation leadership under Subankar Sen has successfully commoditized credibility. They have moved from being a regional trade East India player to a national contender by schooling the competition on how to scale handcrafted Bengal karigari. The company has masterfully deconstructed the Indian consumer, building a sub-brand portfolio that targets specific psychographics rather than just price points. Its Everlight brand targets the office-going professional, which who are modern women seeking subtle, lightweight luxury for daily wear with average trading value of around 46,100 rupees. And second brand, Sennes, which is an ethical lifestyle play, targets urban Gen Z and millennials with lab-grown diamonds, leather bags, and fragrances. So the LGDs will start at an entry point of around 5,000 rupees. And the third brand is Gossip for the style savvy budgeter, affordable fashion, and silver jewelry with an average value of around 32,500 rupees. And Cloud9, the Gen Z entry point, utilizing 18 karat and 9 karat gold to lower the barrier for first time buyers. And the next segment is Aham, which captures subtle masculine luxury targeting the underserved men's jewelry segment. Signia and Classic are the high net worth heritage buyers with an average value of around more than 1 lakh. So, if you see, the company is having nearly 196 showrooms in India, 194 in India, and 2 in Dubai. And its geographic reach, it spans across 18 states and union territories, covering 128 towns and cities, with a total retail area of nearly 5.78 lakh square feet. And companies having a employee base of around 3,000 plus, and with a customer base of 3.15 million plus loyal customers. While this footprint is impressive, the real story is how Senco is navigating a macro environment where gold prices are rewriting the rules of the game. If you see the industry market, the company Indian jewelry sector in Q3 fiscal 2026 was a tale of sticker shock met by anticipatory buying. Gold prices witnessed a brutal 63% year-on-year spike, averaging 12,654 per gram and peaking at a historic 1.4 lakhs per 10 grams. In theory, this should have crushed demand. In reality, consumers rushed to buy before prices climbed even higher. Senco's secret weapon during this volatility was the old gold exchange model, contributing nearly to 43% of total revenue. This allowed customers to trade in old assets to fund new purchases, effectively hedging against record high prices. By positioning itself as India's second most trusted brand, Senco has capitalized on flight to quality, ensuring that even as volumes grew marginally, value growth exploded. This resilience, anchored by the House of Design philosophy, launching nearly 100 new designs daily, has allowed Senco to push through market headwinds and accelerate its expansion beyond its traditional eastern borders. So, for regional jewelry players, geographic diversification is the holy grail. Senco is finally drinking from it. This quarter, non-East revenue officially crossed the 1100 crore mark revenue, proving that the brand has national legs. The strategic launches in Meerut, Nagpur, and Bikaner demonstrated a hyper-local competence targeting Tier 2 and Tier 3 Bharat, where organized retail is still in its infancy. To scale without a bloated balance sheet, Senco utilizes a sophisticated asset-light strategy. So the company has full 11 full one Coco showrooms wherein they have a high control, high margin, but capital heavy, and 75 FOFO showrooms, franchisee owned, franchisee operated. The primary growth engine, Senco bears zero OPEX. The franchisee funds CAPEX, which is nearly 1.5 crore plus, and inventory with 15 crore plus. And 8 showrooms under FOCO model, which is a hybrid model where franchisee provides capital, Senco manages operations for an operation expenditure reimbursement. This asset light engine has propelled the brand to the 196 store mark. But as we turn to the financial statements, we see that scaling trust comes with a significant working capital price tag. So Senco crossed the 3,000 crore quarterly revenue mark for the first time, a watershed moment. But don't let the triple digit growth blind you. So there is a heavy base effect at play here. So revenue surged 50% year on year, but the real headline is the 13.2% adjusted EBITDA margin. So the 792 basis points expansion is partially a mathematical mirage. So the Q3 FY2025 was hit by a one-time adverse impact of custom duty reduction, while the structural shift toward higher margin lightweight jewelry is real. This 13.2% margin in an all-time high and carries significant mean reversion risk. Expect margins to stabilize closer to 7.5% to 7.8% as gold prices find a new floor. The company's inventory skyrocketed by 55% year on year to 4,602 crores. To fund this, borrowings, including gold metal loans, rose 44% to 2,248 crores. The interest squeeze. Senco's blended borrowing margin cost stands at 6.9% in a quarter where finance costs hit 148 crores. The debt burden is real. And cash flow. The company's 9-month cash flow from operations is negative 221 crores against a PAT of 417 crores. So Senco is paper rich, cash poor. While the P&L shows record profits, the cash is currently locked in gold bars and display cases. The CFO to PAT ratio is deeply negative, meaning the business is not yet self-funding its aggressive growth. It is fueling it with debt. So coming to its key KPIs, the company's same store sales growth for Q3 is around 39%, driven by gold price surge. The 21% year-to-date figure is the sustainable metric to watch. Average ticket value is nearly at around 93,000 rupees. A 27% jump year on year reflects both higher gold prices and premium bridal traction. Coming to its stud ratio, which is around 10.9%, which is mostly stagnant. Senco is struggling to break the gold only habit of its traditional customers. And coming to its inventory days, it is nearly standing at 168 days, which is in a range bound. Management is managing stock well despite the massive value surge. And return on equity for the 9 months is around 19.2%, which shows a strong recovery but highly sensitive to leverage levels. So, if you see company's con call highlights, Suvankar Sen has a reputation for delivering, and the 200 store target for Q4 is the line in the sand for his credibility. Coming to its guidance, management is confident in 25% plus top line growth for Q4. With the wedding season in full swing, this is achievable but leaves no room for error. Coming to tech play, with 6.5 lakh app downloads and 1.37 lakh registrations for My DigiGold, Senco is actually winning the omni-channel war, not just talking about it. Coming to LGD disruption, the Sunnes rollout is a direct shot at traditional players. By pricing LGD at 5,000 plus entry point, they are capturing the Gen Z market that Titan or Tanishq often overlook. So Suvankar Sen is executing a masterclass in modernizing a legacy brand. He has been transparent about the debt for inventory trade-off. However, the 13% margins are a gift from the market. The real test of his leadership will be remaining 25% growth when gold prices eventually cool. So the $1 million question, Are you buying a structural powerhouse or just riding a gold price wave? Senco is delivering a 5-year revenue CAGR of 20%. However, the current 30.2% EBITDA margins is nearly double its historical 7 to 8% range. Mean reversion is a mathematical certainty. If you pay a growth premium based on 13% margins, you are walking into a valuation trap. So, Senco justifies a premium over regional peers due to its national expansion and digital traction. But caution is warranted. Current profits are inflated by inventory gains. True value lies in the 25% top line growth, not the temporary margin spike. Coming to some key red flags and risks are debt trap. Total borrowing stood at nearly 2,248 crores. If the interest rates rise or the gold hedging strategy falters, the interest coverage could tighten. Second, regulatory hurdles. The new labor code had a one-time impact of 6.2 crores. More importantly, the industry remains sensitive to sudden custom duty shifts. Third, gold reversal. If the gold prices crash, the 43% old gold exchange model slows down and inventory value on the books takes a hit. So, some SWOT analysis, if you do, what are its key strengths? Trust mode, second most trusted brand with 85 plus years of legacy and design agility, 100 new designs daily, 204K gold designs in library are its key strengths. Coming to its weaknesses, regional concentration, 105 of 196 stores, which is nearly 53% are still in West Bengal, and cash flow, negative CFO of 221 crores with for the 9 months period due to inventory absorption could be a weakness. Opportunities are asset-light expansion, scaling to tier 2 and tier 3 cities via FOFO model is an opportunity, and the LGD traction, lab-grown diamond, SENS LGD starting at 5,000 for Gen Z is a key opportunity. Coming to threats, leverage of 2,248 crores borrowings and 6.9% blended borrowing cost could be a threat, and the price volatility, 63% price spike makes deferred buying a real risk are the key threats. So, what are the some key monitorables to monitor in this company? Senco Gold are the 200 showroom milestone, a Q4 litmus test for management's delivery, blended borrowing cost, monitoring if the 6.9% rate holds or climbs as debt increases, stud ratio stability, can they break the 11% barrier to drive structural, not cyclical margins? 4. Inventory normalization. Post wedding season, inventory days must stay near 160 to 165. 5. Senus LGD rollout. Traction of 4 upcoming EBOs in North and East India. 6. Northeast, non-East contribution, ensuring revenue growth outside West Bengal continues to outpace the core market. So, what we can say is Senco Gold is firmly on track to transition from a regional leader to a national powerhouse by fiscal year 2027, provided it can bridge the gap between paper profits and actual cash flow. So, if you see, do a quick comparison between Senco and Tanish. Senco is rapidly expanding, and Titan remains the gold standard of the Indian organized jewelry market. So, if you do a side-by-side comparison kind of a thing, Senco's edge, Senco is currently growing at a faster clip of 50% revenue surge, but by aggressively capturing tier 2 and tier 3 Bharat through an asset-led FOFO model. They are also aggressive in the lab-grown diamond space with Senes, undercutting traditional price points. Titan's edge is the margin play. Titan has much higher stud ratio. Senco's 10.9% stud ratio shows they are relatively still heavily dependent on gold volumes, which makes them more sensitive to gold price volatility. And the risk factor, Senco is fueling its growth via debt. Titan generally operates with a much cleaner balance sheet, whereas Senco is currently locked in a debt for inventory cycle to keep their 196 stores stocked. So these are my observations. If you found this video useful, please do like, share, and subscribe to my channel, Murthy Finance Academy. If you have any questions, please drop a comment and I will try to answer them. So every day, I'll post some key players in particular sector on a day-to-day daily basis. So please do not miss them. Please subscribe and encourage. Thank you.